Hello, Warriors. Hi, Shahab, Michael Bergman, Michael Weissman. How's everyone doing today? Team, how are you? Everyone
Hey, good
okay?
morning, Coach.
Hey, how are you, Blake? And Ryan, it looks like you didn't miss it.
Nope.
Okay, so it really came out of the hole yesterday. And what are you thinking now? We're not confirming. I know some people have targets a little over 130. You have any numbers to the upside?
Yeah, that 130 is going to be interesting. It's a big psychological number. It's a big fat round number. Maybe some barriers sitting there too. So I might give it a little tap on the first try.
Okay.
But what more interesting is Euro Sterling's tapping the big figure now.
Okay, so is it being patient and waiting for your areas and letting the market come to you paid off instead of getting FOMO and chasing and saying, I missed it, I may as well be in?
Yeah, well, I'll let you know if it pays off. I'm trying a little big figure trade at the moment down into here. We'll see whether it pays off or not. I'll let you know tomorrow.
Yeah. Anyway, well, I mean, it paid off that you didn't chase it because that's what I'm saying. So it's that fine line for traders and everyone that watches us that if they feel like they missed it, that it pays to let the market come to you, because you're changing your whole game plan if you think you missed it and then you commit to the trade. That wasn't your trade.
Exactly.
So that's all psychology too. I mean, I don't care what system you use or what kind of charts you use or anything. It's all psychology. So and talk about psychology. I mean, this was set up pretty good for, extreme positioning the other way. I didn't think it would get here this fast.
No, it's very dangerous at the moment trading this one. We pointed out a few levels yesterday, but it's just carving through the levels.
Yeah, that's what
I mean. These were sort of the levels that developed on the way up, so they are pretty short term. But even so, what's interesting with them, is that they're carving through, then they're holding immediately after resistance.
Yeah,
as resistance. So when you get a pattern like that, you know that rally sellers are hammering this one.
I mean, once it topped, I thought it would be a natural to come back and check the 38 level. It could rally first, but I mean that's going to be an important area to defend to keep this trend going. It'd be a failure, a breakout failure. I don't care if a breakout failure happens in 3 days or 3 months, it's still a failure. So that's going to be the battle line, huh?
Yeah, you need some context as well. I mean, as I pointed out in the chat room earlier, the 38.2 fib of the move since March, so this whole rally that we've seen, is still down at the low 139s. So it's not even close to really testing the trend yet.
Yeah.
So even though this is a huge move, it's not trend breaking just yet.
Okay.
And that's what traders need to keep in their mind. It doesn't mean it's not going to break, but is this just the pullback that hasn't happened over the last 3 months?
Yeah. Could this be, you'll know you have a trend break if you start trading under 38?
Yeah.
I mean, I don't, that is like the key area for the case of the uptrend as well.
Yeah, there's 3 levels for me. There's a bit of confluence around this 139 0020, call it. There's a 38.2 fib. It was a prior action point. We've got a trend line coming through the lows from late March. So a bit of a confluence there. Then you've got the big 138. Then you got the 50 fib at 137.35. If you go through all those, then obviously something's changing. And but again, we would look back in 6 months' time perhaps, and that 145 level that we were flagging months ago, weeks ago, it's a big solid level again. It's why we highlighted it.
Okay, so I'm just looking. So the Nikkei didn't really come back much, but holding support here. and the yen is still going down. So let's see if they're connected. I mean, if we get a rally in Nikkei, let's see if that is a catalyst for the bounce,
Yeah.
because the decline certainly was. So why not just see? And this doesn't look as bad as the yen break did over
No.
these course of days. But anyway,
Well, yields to know what's giving the dollar yen a second wind lower,
yeah,
second tailwind.
another
Back under
reason.
4% in tens.
Yeah.
We're all scratching our head why it was above 4%, and now it's come back below 4%.
Yeah.
Back into the box.
It could fall all the way to 380.
Yeah.
But you're right. It's definitely pulling back after a huge move. I don't know if I could call it a top, because the momentum was just so strong up here.
Yeah.
There was a little divergence here, but it was over 70. Almost had a little 3 here. So I don't know. There are a lot of people looking for. I've seen tweets about false breakouts here in the yields. For me, that would have to be trading back under 380, because that was the really the breakout.
I agree 100%. By the way, good morning.
Good morning, Stel. So it could pull back to 380 and then resume.
Yes,
it's a tough trade.
It will depend on, I think, on the CPI obviously tomorrow.
Everything.
My call is still for a slightly disappointing number compared to estimates. I actually think headline CPI is probably going to be, in my opinion, 2.9 and 4.9 for core. So if that happens, I think yields are going to have trouble staying above 380. Let's put it that way. But let's see, one step at a time. And as I said on the Flow Show this morning, I think if we do see more weakness in inflation, then we're currently pricing over around 90% chance of a hike in a couple of weeks' time. Well, that I think could go down to 50-50, and then all options are open for the Fed. I think the most likely scenario is that they still hike, but if inflation disappoints to the downside, that's what they need. That's what they want to see, for them to say, look, 6 to 12 months from now, we think inflation is going to be at target. And why wouldn't it? If it's printing 2.9 or 3 or 3.1 now, why wouldn't it be there? So they're going to have plenty of reasons to be dovish if they want to.
Gold trying to come out of here. Looks like it wants to attack 1960. I've been looking for this rally. There are a lot of people saying this turn is going to be the turn for new all-time highs. I think we could get a good rally, maybe even 2000, and then have something like this again. And
it's a little inverted head and shoulder pattern intraday developing there, Coach.
What's the time frame?
4 hour, and the neckline 1935, targets 1970 if it gets a hold.
Okay.
The scary thing about trying to trade that is what's happening in less than exactly 24 hours and 30 minutes. Yeah, I mean, with that's going to be the catalyst. Hey, good morning, Stelios. Ryan, I know I said hi and good morning earlier to Ryan. Stelios, we got some comments in the chat room from Lucas, who said, hey, Stelios had a great conversation about, on the Flow Show regarding inflation and housing, and and you got a lot of great comments. And I jumped in there and I said, he has no idea what he's talking about. So he obviously, kind of schmoozed you over. No, just kidding. But he did give you some really positive comments. So what were you talking about as far as inflation and housing on the Flow Show?
I can show it actually. Hold on. Let me share my screen.
Here, let me stop sharing. Go ahead.
I think I can. Oh, there we go. Okay. So there's these charts which I found on Twitter by this lovely, I think, Greek person. Anyway, it's numbers from the BLS, and they're showing how CPI has changed, and compare that to CPI ex shelter, and it's showing how the shelter part, the housing part, moves a lot slower than has a lag basically. So on the way up, ex shelter was moving a lot higher, including shelter. So the headline CPI, including everything, was kind of gaining ground, and now X shelter has been dropping fast. It's actually 2% already. And the all-inclusive CPI, which includes shelter, is dropping, but at a slower pace, but it's going to be, theoretically, it's going to be catching up. So it kind of lags on the way up and lags on the way down. I mean, the headline CPI, and also same with core CPI and core X shelter, it's the same thing. It's lagging and theoretically should be dropping more. And it is one of the reasons why I think that the inflation prints are going to be coming in lower and lower. I mean, where do they stabilize? Who knows? But especially the headline CPI, I think is going to be getting to target at some point and quicker than people might think. So
the question will be tomorrow, are the numbers going to come in worse than expected or in line? I understand that the idea that CPI is going to continue to move lower towards the Fed's 2% target, but tomorrow is tomorrow, right? Is the data going to accelerate quicker tomorrow, or show that it's accelerating quicker, or not? What do you think?
Right. Yeah, Ryan says Thursday could also, completely throw off the results from what happens Wednesday. It's like, I don't know, maybe we have to.
Well, PPI has been PPI has been that Ryan. We were talking about that 2 months ago, right? Where PPI was that like what the kind of caught everybody off guard, right?
Yeah. I think the PPI you've got to look at in the context of if CPI tomorrow is higher than expected, or it doesn't drop as much as expected, and the market thinks, okay, sticky inflation. If the PPI then comes in a big negative, big minus number, then that will change the picture. Of course, if they both come in higher, then Evans knows what's going to happen with the dollar and yields. But I think at the moment, there's something cooking in yen pairs, and that's not to be ignored. And we've seen it. Dollar sold after every decent print we've had last week from the US, and I think we're firmly in rally sell mode until something happens. So even a hot CPI number, you get a dollar rally, I think that gets nailed, particularly in dollar yen.
Yeah. I mean, the dollar yen is definitely coming under pressure. One of the gentlemen that's in the macro room that's been with you for a long time, Ryan, he put in a really good write-up from I think Mitsubishi Bank. I forget which I'm trying to think what bank. About the yen and the overarching theme there. I mean, this has been a hell of a short squeeze in the dollar yen. You were talking about some of the key levels, and Dale, I'm gonna just show you here some of the important levels, in my opinion, on the dollar yen. We broke through what could be considered as channel support. I mean, if you take the upper, all the upper price rejections up here, connect them, it actually coincided with the 618 also at the breakout point at the 141 level. We're below that, but Ryan, I beg to differ with your fib levels, and this is the reason why. If you take the lows from January of this year, right, to the highs, which would be this year, right, those highs, that is the 24% retracement. Just that we just broke through overnight at 141. The reason why I was watching that overnight, because I knew it was the 24% retracement. First even potential bullish, stopping point. We sliced through it like warm butter. The 38% retracement is actually at the big breakout point that Dale, you were talking a little bit earlier, which is 138. Right. So that is actually the 38% retracement. That's why, in my opinion, this is the only number that really matters to me moving forward for dollar yen is right here, is this 138 level. Because if that breaks, not only does it break the back of the bullish trend that we've seen, this 38% retracement here, but then it's back below a breakout point. And then I think, that I actually believe it might be.
I love that wedge you have in black.
I mean, this could,
and the throw over failure, and so where do you have that the bottom of that wedge anchored at 34? I think 34.
The bottom of this wedge right here. It's 34.
It can go there.
I mean, I think it's all doable. The one thing I would like highly, you know, advise you right now is you have to be really careful trying to, you know, chase it lower at this point. You know, I mean, look, we just had a 300 pip, just absolutely capitulation below the breakdown point right here. So you have to be a little careful with, you know, your positioning at this point.
What do you think it means, Blake, to outside markets, implications of risk on? Does it is it sending any message that maybe markets are ignoring right now that we
No,
can
I
take
think
cues from it?
I think it's been, you know, I'd like to go to the Nikkei and go, oh, well, you know, maybe the Nikkei should be selling off, or maybe we should see stocks, you know, under pressure. But I mean, it seems like it's been mostly a yield move. That's what it seems to me. It'd be, and you could actually put some dollar into that, pepper some dollar into that too, because we've seen obviously some downside pressure on the dollar. But I don't know. I mean, I haven't seen any and felt any.
Maybe lower yields also mean a weaker economy, and you know, maybe we get the narrative shifts if we're going to have that decline in yields. That would surprise everyone now. It's because
perhaps
of a growth scare.
And I have to mention that you know, if you're looking at, you know, like a risk aversion, you know, risk appetite type of move, and the yen has not been really responsive to that. Actually, I think more of the you see when you see stocks actually rally, sometimes you see the, you know, the dollar yen do opposite of what you would think it would do. So I would say that if you're looking at that correlation, it's not very accurate at this point. So
if you put up a weekly S&P chart and a weekly yen chart, I'll use I beg to differ. So I mean, look at the weekly.
Yep, there's a weekly, and we can add
the S&Ps.
Yep, that's the S&P. We can add the dollar yen to that if you want to take a look here.
Yeah.
And I mean, look, the dollar yen's kind of been on its own program, but you know, hey, maybe at this
last
point,
risk rally, maybe.
Yeah, maybe it is
gone together. Anyway, just something I noticed.
Yeah, I mean, they've you could argue that the dollar yen stopped short of its highs. Yeah. So is the S&P. So I mean, you know, I think you could argue that point.
Yeah.
Yeah. Okay. All right. Well, hey, look, we got about 15 minutes before we have, you know, pass it back over to you, and we have Dave Keller, CMT. He's also the host of the Final Bar. He's coming up. Great technician. You know, probably one of the nicest guys that I know in the market. So make sure you all stick around for that. But I want to talk real quick about this UK jobs data, because
he's a saint, Blake.
He is. He's a really nice guy. If you missed the cable, hit the 127% extension overnight. You can see right here. You know, we were talking about it last night around, you know, hitting this 127% extension at 129.25. You can see right there, next resistance is at 129.25. We basically hit it, reversed, divergent relative strength. You had numbers that came in overnight. Ryan, Stelios, Steve, I think Steve's here too. The number was decent, right? But it was more of the earnings, the average hourly earnings, or whatever you guys call it in the UK. It was the average earnings index came in a little hotter than expected. So, I mean, the Bank of England is already expected to raise rates by 0.5% in August. So, does this change the picture at all? I mean, that's why, I as a trader, and I'm sitting there looking at the cable this morning, I'm like, yeah, we already know that. We know that the Bank of England is going to come in, you know, kind of aggressive this next meeting. So what are your thoughts on the employment data that we saw overnight, Ryan?
Well, the ramp to 50 pip expectations for August is only just happened recently.
Yeah, but it's already there, right? I mean, like you say just recently,
it's
but
not
still
fully priced in, though. It's not fully priced in yet, is it?
No, it's been growing. It was priced at 25 over a 50, and now it's switched to a 50 over a 25.
Okay.
But it's no surprise that the data was hot, that the wages data was hot. Been saying it for a while. It's still sticky. I looked, in depth at the numbers, because the public sector, we have public sector pay, private sector pay. Public sector pay is always depressed. Usually you'll find it around 1 to 2%. It's up at 5.8%, the second highest since 2001. And that falls on the government, because the bulk of public sector pay is paid for by the government, NHS, that sort of thing. So it's a big pressure coming in for those guys. And the wages don't stop. And we've still got pay disputes to be resolved. There's just no end to it. And Bailey and co are whistling in the wind if they think they're going to stop that anytime soon, because the higher they take rates, the more pay people will want. So we're in a spiral, and I don't think we can break it, personally.
Oh yeah, and that's a scary situation to be in. What are your thoughts here, Stelios, regarding the UK jobs data?
Well, I think that, as we discussed on the Flow Show, the Bank of England it has no options. They have to keep hiking. And we said, pricing 50 or a good chance for 50 is fair, because inflation is 4 times their target, and it's not slowing down. And wages growth is not slowing down either, and that's going to bring second round effects, etc. So do they have a choice? No, they don't, because they have no other weapons, really. They have to keep tightening. So for me, and I've said this for weeks now, I'm constructive and bullish for the pound against most of the other majors, because of this central bank divergence, which I think will continue for maybe the next few months, or maybe even the rest of the year. But after that, obviously, all bets are off. But for now, they have no choice. I mean, I don't know, what would you do, Blake, if you were the Bank of England chair? I'd
bite the freaking bullet, and I'd ramp up rates like the Fed did. Like tuck it in between your legs, pal, and just bite the bullet is what I was going to say other things, but you guys know where I was going with that, because if you're Bailey, you're sitting there going, yeah, I can't, I'm too late. Well, you know what? The UK economy is taking it in the sphincter because of it. So just do it. Just do it.
That's the thing. The Fed was also late, but they went in a big way. They did 75s. Yeah. So that's what the others should have done as well. Now they're late. So what do? They have to now do what? 50s? Yeah, probably.
Yeah, and I guess the point that Ryan you're making is, and most other people out there, is they won't, right? So I mean that's it. Yeah. I was watching when Bailey I was almost said Kuroda Ueda and Christine Lagarde and Jay Powell were on they did their little Japan hosted event, and man, he looks like a little squirrely guy. Anyway, the Euro Sterling. I'm sorry I said that. Excuse me. So the Euro Sterling is breaking lower. What are you going to do with that, Ryan?
What am I going to do with that? I'm going to buy it. That's what I'm doing at the moment.
You're going to buy it? Okay.
I'm having a little play against the big figure. I've been watching this 85 for long enough. I might as well try and drop some beans on it. So
okay. Divergence, Ryan. It's not confirming.
No. If it does break, I'll start buying it probably for the longer term. Maybe from 84s, and I'll be happy to buy it down to
83 and a half. I have spoken a long time ago about that. Come on, Ryan.
Yes, with the program. I'll probably start from 84s, because I always go too early, and I'll buy it down to 80 if need be.
Yeah, I know. Isn't that crazy that I feel like literally I'm always like a day early, like almost universally. Do any of you guys feel that way? If you do, jump in the chat box and tell us you do. Anyway,
a day is great.
Huh?
For me, to only be a day early is great.
All right. So if you take a look at the euro dollar, we hit the underside of this broken trend line. And last night I was looking for that. Really, is if you look at the analysis last night, we were looking for a move to the 127% extension underside of the trend line in the euro. Let's go over to the euro here, right there. You can see we're looking at the underside of the broken trend line overnight at 109.25 as possible. We hit it and reversed it like literally within 2 pips, and we've come off pretty aggressively. With the euro sterling under pressure, I would think that the euro continues to come under pressure, but take a look at the dollar index. You know, initially I had the dollar index drawn as a triangle with that red line, but then I redrew it this morning. If you look at the lower two data points right here, and it connects to the 78% retracement. And then if you step back a little bit and you look at it, I actually think that maybe I had it drawn incorrectly first as red, and blue being more of a symmetrical, which makes sense to me, because we have CPI tomorrow. So it feels like to me, the dollar weakness that we've seen overnight, you're going to see that unwind ahead of tomorrow, because tomorrow is a big deal. I mean, it's going to be the biggest, data of the week. Anybody who's leaning into dollar shorts going into, the CPI data tomorrow, especially if they're late to the game today, or in European trade or maybe an Asian trade, they might start, taking back some of those dollar shorts going into the next 24 hours. So I'm thinking the dollar does recover a little bit later today ahead of the data tomorrow. So I think we're going to continue to see a dollar bounce. Dale, what do you think is your play today? What are you thinking today we might see out of the markets? And I'm going to go around the horn and see what you guys are thinking.
I think everything depends on the 2 numbers. You could make a case for one more high in S&Ps on good news for a 3 drive. There's 2.
Okay. You're talking about the CPI data tomorrow, because today is kind of like blah. Okay, there's not a whole.
So I mean, I don't see any reason to do anything today. I'd rather react to the numbers on the next couple days. So if you were caught the shorts out of yen, nothing wrong with taking almost all of it off. And if I got to rally back towards 42.5, 43, I'm a seller over the next couple of days.
Sounds good. What are you thinking, Stelios, for today? Any ideas? I mean, especially with this move that we're seeing in gold, we've got this gold inverted head and shoulder pattern. It's, you can see we're probing some pretty key resistance here. Any thoughts?
I think today is good. We talked about it on earlier when gold was up quite a bit more. It was above 1935 and silver platinum were above. I think it's going to be chopping. I'm not going to put any weight on today's price action at all. I'm going to wait for tomorrow's number. So sorry, nothing to really say.
Okay, Ryan, I heard you want to trade a little counter trend, picking the euro sterling off at the big figure here. Is that your idea of the day?
That's it, and maybe a first knock of cable if it touches 130 or gets close to 130.
Okay,
I'll give that a go on a first hit, depending on how we get there.
Got it. I'm running a little bit of a sterling short right now, so I'm with you. Steve, if you're here, did you have any thoughts going into today?
I'm not here.
Okay, then let's continue on. Steve, what are you thinking right now?
Where are you then, man?
I'm somewhere else. I'm on vacation. Thanks for asking.
Yeah, that's a typical Greek in the summertime. All right. So what's up, Steve? What's going on?
Good. I'm watching the breakdown in the dollar. I think it's more or less confirmed now. So I'm watching actually to see. I'm quite curious about commodity currencies. Commodity currencies, despite the breakdown in the dollar, are still performing really, really badly. So that is definitely one thing I have in my radar, along with USD dollar and obviously the yields, which are the big elephant in the room.
Yeah, for sure. The yield move, I know we talked about it yesterday here on F.A.C.E. Big rejection here. If you look at the 10-year, the actual notes futures themselves, we hit 161% extension, horizontal support. That has created a bounce. I wouldn't get too excited about yields falling too aggressively unless you get back above there, which is 112, by the way. And we start getting back above that level, and then you got to start thinking, holy shit, maybe this dollar yen is going to trade back down to 138. But again, I'm in the camp, and I know Steve, you said that you're confirming that the dollar move is lower. I'm not quite there just yet because like I said earlier, I think I might have drawn it incorrectly initially. You can flip this one into red versus being black or being blue, right? And this would be more of like blue. So this way you could see the difference here. That might be more symmetrical. Anyway, because we have CPI tomorrow, and I'm not 100% in the camp that we are going to see more and stronger disinflationary numbers. I think tomorrow's CPI is going to be very, very important. It's going to be important for what camp you're in as far as the stickiness of the inflation, or if we are going to maybe at some point in 2024 see deflationary data, which hell, in this environment, based on what we've all been through over the last several years, and I know, deflation is not something that's not a common term, and that's not something that those of us that live in the real world ever really see. But anything's possible after these last few
literally
years.
We don't ever see.
No,
I think that during the big financial the crisis,
GFC.
yeah, if I remember right, we had a single month of deflation. That's it. That's all the deflation we've seen during our career.
And I think gas prices at that time went from $2.50 to $2.45 a gallon here in the U.S. Just kidding. Just kidding. That was our deflationary spiral in the U.S.
That's all the deflation we've seen.
That's it. All right. Well, hey, Dale, I know you have Mr. Dave Keller here. He's always great to have. And as you mentioned, Dale, he is a saint, truly one of the nicest guys, I think, in the financial sphere. So, Ryan Stelios, keep up the great work on the Flow Show. I know K-Man's going to be out for a little bit of time. So you guys are doing a great job holding down the fort. We got a lot of comments in our chat rooms today about how great the Flow Show is just with you guys.
Mainly me though, right?
Yes.
Mostly you.
Mostly
you. Correct. Mostly you, Stel. And Steve, nice to have you here. Dale, thanks for always hosting us and taking care of us. And have fun with Mr. Keller. Dave, welcome to the show.
To be in the know, go into the Flow Show.
Nice.
Okay.
Didn't rhyme that well, but I agree.
I know. I know, Steve. It's not my best, but it's the real.
Your best is still better than Steve's, Dale.
Oh, thank you
100%.
so
much.
100%.
That's for sure.
Thank you, David. Gosh, it's probably been a half a year or so since I've had a chance to talk to you. How are you, buddy?
Too long, Dale. How are you? It's good to see you.
Yeah, it's good to see you too. So I mean, we have a new bull market running. Are you in that camp?
So yes, and I would say it's the challenge right now is what time frame you're talking about, right? I think the long-term time frame to me certainly seems constructive. In the short term, I'm seeing a lot of danger signs kind of in the classic pullback phase, suggesting we've had a really good run. We need to pull back a little bit, reset, and arguably if you're bullish here, it's kind of counterintuitive, but the best thing you could see here is a pullback that gives a chance to reset and sort of take some of the euphoria off the table, which has been, I think one of the concerns in the first half of 2023 for sure.
So some of those warning signals is it put call ratios? What are the things that?
So I would actually just look at price momentum, right? And I'm looking at Amazon here just as an example, one of the mega cap growth stocks. So one of the things that happens.
Look at that divergence.
Yeah, sort of it's classic exhaustion signals, right? We have this big run higher prices, lower momentum. I mean, it almost jumps off the page if you study it and look for these patterns. It kind of comes off. The problem is the chart of the S&P kind of having that same pattern as well. You're seeing it with some semiconductor names like let's see, LRCX is a good example of that.
AMD has been weak. There's been some weakness. Nvidia, I think that would may perhaps be the catalyst, Dave, if Nvidia started to come off and work into the gap, because that's really what got the party really flowing with buckets of champagne. Right?
It's well put, right? And if you
Yeah.
think, I mean, just the strength of semiconductors in the first half, they were really coming out of the October lows. Was pretty impressive, and that became a group that I think the market sort of rallies around, pun intended, and continues to go higher. So the challenge with stocks like Amazon and Nvidia and others showing that exhaustion pattern, if they would roll over, even if every energy and materials and industrial name you name went higher significantly, if all those names roll over, the major indexes and the markets as we define them are going to struggle. And so with our growth oriented benchmarks, you really have to focus on growth. And I'm just seeing a lot of exhaustion signals here, going obviously in a pretty significant week with CPI and then the Fed coming up as well.
Well, I had real lousy timing in buying Apple puts, some from the 170-ish level, and then some from the low 180s. And if you look at Apple, even though it's going to rally, you see that last gap up? Isn't that, you're talking exhaustion, so isn't that an exhaustion gap? Because you do have other gaps underneath the market that could have been breakaway gaps or runaway gaps, but that looks like an exhaustion gap to me.
So Dale, as always, you're eloquently speaking the language of technical analysis, and you're 100% right. So after a big move, gaps can happen at different phases, right? You have, a breakaway gap, which is kind of early on the move, right? Sort of a basing pattern.
Down there in May.
Reinitiates it. This is more of an exhaustion gap.
Yeah, see the May gap up, that was earnings, I believe.
Yeah, so kind of a basing pattern, kind of a sideways pattern. All of a sudden something changes, something's different. When you have an established trend like this and you have that gap higher, it's like that last gasp, right? It's that last big jump. And then it's sort of like the music stops and everyone looks around and says, okay, hold on, where are we? And then we start to see profit taking. And so, and again, I'm seeing these sorts of signals on too many names to not expect a decent pullback here. But again, what you have to remember is on any of the charts that we've just shown, on Apple, on Amazon, on Nvidia, on any of the others, there's a lot of room to pull back and still be within a pretty reasonable uptrend. And I think that's the reality of what you can expect here July into August.
Okay. Great. Do you have a handle on interest rates, Dave? I mean, they've been all over the map. 10-year took out the 4% handle, and bonds.
I don't know if anyone has a handle on interest rates at the moment, Dale, but I hear you.
Yeah, even the Fed, right? So
right. We're all trying to make sense of this.
They say Powell's exasperated by how much he's tightened and really not seeing the effects in certain things. But
so I mean, when you think again, there's the sense that the Fed, I think, tries to portray, which is this omnipresent, omnipotent. All we need to do is pull these levers and everything's going to be fine. And they work really hard to convey that message. I think in reality, if we really study what the Fed is trying to do in, raising rates and slowing the economy, it is, I mean, you are really like trying to steer the Titanic with a rudder and just barely trying to move this big machine with a huge lag between what you do. It's like a really sluggish airplane control, and you're trying to move it. There's such this lag between what you're doing. So rates have been pushing higher, right? And I was listening just at the end with you and Blake and others just talking about the conditions here. You've seen bond prices pop lower here, and I think for me, I'm looking at this, sort of on that medium term time frame. Rates really were consolidating for quite some time, really about 9 months. When you look at the, October high around 4.25, from there, it's been sort of this consolidation kind of basing pattern. And then just in the last week, you've seen a pretty significant change, breaking above around 385, now pushing above 4%. I think, the reality is what the Fed is trying to do here is change the conditions.
Okay. And do you think they're going to go? I know you're a CMT and not an economist, but do you think
so from a technical perspective, this is a new uptrend in bond rates, right? This is the new uptrend in interest rates.
What would you call that formation? Because I kind of had like a flat bottom, and it looked like a descending triangle, but I guess it was just a pennant.
Yeah, so it depends. You could arguably call this a flag pattern, which would be sort of this big downtrend and then kind of a parallel decline there as well.
Yeah. Yeah.
And again, whatever you label it, this resistance at the top is pretty important. So the fact that we've broken that, to me, in technical analysis and investing, is all about determining what the trend is and then figuring out what you would need to see to change. And I think at this point, bonds are going down. And if you look at what's happened over time, this sort of environment with rising rates is really not great for growth stocks. It's really more inclined to value stocks. So when I'm seeing new 52-week highs in the industrial sector, you're seeing energy stocks start to get a bid, oil services bouncing off of the lows. That's kind of playing into this growth, take a break narrative and rising rates. And again, I think that could be more of a short-term phenomenon than the long-term. But I think if you've been riding the growth trade through 2023, this would be a really good time to sort of unwind a bit of that and watch a pullback play out.
So, I mean, this would portend new highs, a formation and a breakout and even a breakaway gap that we have here.
It suggests much further upside for the 10-year yield. And again, I mean, on a chart like this, I'm looking immediately to the left and seeing 4.25 as a pretty decent resistance. You see the dollar sort of heading back towards support, as Blake's chart I think was showing earlier. That's all true, but I think again, just because we've hit those levels doesn't mean those levels can't be broken for sure.
Yes. Okay. So the market's been able to handle and not. Okay. So the market has been able to handle it. So you think we'll see rotation out of the big tech and into value trades, value shares, right?
Very much. And if you're looking for charts that are compelling, right? I mean, I'm looking at something like the industrial sector, right? Making a new 52-week high. And this is as growth stocks have made a run. And you compare that to the chart of like an Amazon, and you can see the difference here, right? This is sort of an extended rally. And then the divergence really playing out, sort of showing the end of, are basically expecting the end of the move and showing a trend that's going higher, but on much weaker momentum versus industrials, which is actually thrusting higher on stronger momentum. It's actually been sort of anemic for quite some time. So this is that breakaway gap we talked about. And you're seeing that on names like that. So, I mean, it's stocks like building materials and home builders are kind of tangentially related to this. Airlines, right? Sort of pushing higher. So it's a lot of these areas of the market that have not been sort of the juicy parts in the first half of the year. I think in the third quarter is where you start to see some real opportunities. And again, what's going to be funny is, or not funny, but what the reality is, the S&P, the NASDAQ could retrace quite a bit, while something like industrials and energy are actually flourishing. And if you go back to the first half of 2022, you see exactly how that plays out, where benchmarks are driven by growth, not by value.
Okay. I wanted to ask you about the view that you have possibly in the dollar. So, what it's projecting for you. To me, it looks like, we broke down last week, and you would think this would be pretty good, a benefit for stocks. Weaker dollar usually is risk on for some stocks anyway. So
I think, and again, I don't know whose chart I was seeing right when I was logging on here, but I was trying to just catch up with what you're saying. I think this level right here is pretty significant. And and to me, that's the level that I'm watching. And as long as we hold that, I think you're pretty confident in what we call a basing pattern. A basing pattern is basically, it's not a directional move. It's not a clear uptrend or a clear downtrend, which we saw previously. It's more of a consolidation. And this is really a market in equilibrium. This is the market saying the dollar is about 103, and we're just kind of overshooting and undershooting that level. And what you look for is when we break out of the basing pattern, right? At some point, we don't do this forever. At some point, we sort of resolve this pattern to the upside. We get above the 200-day, maybe above 105. Or we break down and we make new lows. And I think that break in the dollar is going to be very, very telling. For me, I see this as a key support level. Wouldn't be surprised if we pull back to around here. And then as a pullback starts to happen, I wouldn't be surprised if we actually get a stronger dollar there and get a little more defensive in the near term. But we'll have to see. I think that level of support is significant.
Clean out all the dollar bulls first before there's a turn. in the Dow.
Yeah, right.
Something,
and you see the same
like
on the chart of gold, right? You guys were talking about that as well. It's
yeah,
sort of
the gold
that...
shares, yeah, they look like they're turning for at least a trade to the upside. Gold and
and
shares.
one level I would point out to you, I think what you have to think about is the symmetry in gold over the last year and a half or so. So if you take the November low, which is around 1620, take the high in May, which is around 2085, 38.2% of the way down is 1906, which is literally right around where we've been over the last week and a half or so. So a bounce here actually makes sense more on that longer term level as well, which is in perfect symmetry to what we saw on the way down, kind of very similar levels. And so I think a tactical bounce here at least makes a ton of sense. So I think betting on that a bounce in gold is pretty good here. Gold, I mean, it's funny. A month and a half ago, gold was one of the better charts you could find in terms of this nice uptrend breaking out. It's really pulled back in a meaningful way. And the chart of gold may be a preview of what we see on some of the growthy stocks that have had a pretty good run as well. So I think that's a good actionable rally point right here.
Yeah, I actually think it's bullish that it only pulled back 38% instead of halfway back, and it was and it was more of a time correction than price correction.
It's a really good point. Yeah, and what you have to remember, right? There's two ways you can correct: price, meaning a big pullback; time, meaning it's just the market has to take time to digest things, or both. And I think here you've had sort of this slow kind of steady pullback, which has been more of a wait and see sort of period, but now pulled back just enough that it's reasonable to go higher here. I think you're right. I think for me, Fibonacci retracements, I mean, are just a good framework. It's a good way of looking at what's happened and just thinking about where we're at relative to where we've been. The fact that gold's only pulled back this much tells you it's not an end of the world move we've been in. It's more of a pullback within a larger pattern
bull market
we've been following.
Okay, and let's get to what made headlines while you and I were not in touch, and talk about the regionals. And they've been holding, but is there anything to convince you like KRE has bottomed? To me, it looks like it needs to break one more time.
Yeah, so the financial sector, again, a lot of these stocks have had really good rallies, but they're rallies off of such beaten down levels. And so that's a tough one to play, because it's not like a basing pattern, which is more of a sideways pattern, and then we break out. This is more of a beaten down sector, and it's just trying to find a footing. I would agree with you on KRE 44 is the level. I have an alert set for the KRE above 44. And I tend to go with what I call the line in the sand approach, right? As long as the KRE remains below 44, whatever rally we have is still sort of a bottoming pattern. You could see this as a big inverted head and shoulders bottom. I think that might play out, but you have to get above 44 to validate that pattern. And so I have an alert set for 44. I'll worry about it when it hits that. I think when it hits that, that tells you that there's been a recovery. And I would say with some areas, I mean, if you look at something like JP Morgan, there are stocks that are starting to look a little more constructive that actually have had basing patterns and are starting to resolve out of there, but they're kind of the outliers. It's not the average stock. The average one's still
Wells Fargo looked okay until last week, but I mean, it could just be another failing rally.
And that's another side. It's not just about whether these stocks get a signal. It's also about the follow through, right? And I think one of the telling technical takeaways you can draw is when something seems like a real obvious win and then it fizzles out. That tells you that there's just not a lot of momentum behind that move. That's the concern on a chart like Wells Fargo for sure.
All right. Well, speaking about a lack of momentum, wouldn't you consider Goldman Sachs one of the best of breeds for a long time when it comes to this sector? And
certainly, right? Yeah. I mean, when you look at leadership areas, that's the one that would come to mind. From a technical perspective, it's really been a choppy. One of my analysts used to say it doesn't chart well, and I think that's a good way to describe Goldman Sachs. I mean, it's just it's been more of a mean reversion experience. It's not really. I mean, at a time when you have certain areas of the market, industrials, airlines breaking out, gambling stocks working, you have things clearly breaking down, like energy at times. Then you have a Goldman Sachs, which is more of a choppy sort of sideways experience. And I think this chart is more about mean reversion than anything. It's more of, I mean, really Goldman has been at around the same level since, you know, the beginning of 2022, and it's been just sort of chopping around that sort of level. So I'm encouraged by the fact that we're at the lower end of the range here that we've been for the last 3 or 4 months. But in my opinion, is that the best lever to try and pull in this environment? Probably not. I would say that
I mean, we're not that far from the March low.
That's very, and that's what I'm saying, right? We're sort of at the lower end of this range, and that is very much a check in the, you know,
with a strong market.
Very, very true. Very, very true.
I mean, if you're a believer in relative strength, readings and how they behave, Goldman has made no hay out of this huge rally we've had this year.
No, that's totally fair. And here's the relative strength line. You can see how weak it's been on a relative basis. I mean, it's been the financial sector in general has been sort of a forgotten area of the market at a time when, if you look at what the conditions and how they've evolved, you would think financials are probably doing a little bit better, just given a rising rate environment, given what could be the scenario in the coming months, but not yet.
Yeah, I think that they all look kind of vulnerable to me. So, you know, and I'm not sure what they would prefer, higher or lower yields, but the charts say higher, right, David? So,
but
you would think that would help.
Is what the charts say.
Yeah,
something else.
Yeah. Anything else that you'd like to cover that's top of mind, or the way you're looking at the summer? Someone's asking you what you think. Carl wants to know what you think about the NASDAQ rebalancing coming up. What are they going to do? What the Dow did and kick out the weak sisters and bring in new leaders?
Yeah, so you know, it's funny with I mean, it's not funny, but with indexes like that, there's always a rebalance of sort. Not always, but you have to remember that when you think of something like the NASDAQ 100, you think of it as a static group of stocks. And the reality is all of those indexes fluctuate. And if you look at the S&P, the Dow, the NASDAQ as well, I mean, all of these indexes, they're fluid in terms of the members. So when you're looking at a longer term trend, you're looking at less and less of the same groups of stocks that are playing out over time. The NASDAQ rebalance is really going to try to address the overweight in the mega cap stocks, right?
How are they going to do that?
So what they can do is just kind of change the weight, and I think they're talking about just redistributing the weighting. So taking, you know, redesigning it so it's less of an overweight in the mega cap names and redistributing that to some of the smaller stocks within the index. So sort of recalibrating it. And this is the fact that they have to do this tells you probably all you need to know about the challenges of this market and the narrow leadership, right? If you take the Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet out of the picture, the equity market in 2023 has not been particularly strong. It's actually been quite mixed. And so what they're going to try to do is alleviate that. I think that's more of a sign of the times of this overweight, and I would say that
it's kind of like trying to stack the debt because they're worried about the hand they're holding.
It reminds me a lot of stocks becoming very overvalued. So instead of thinking of that as a bad thing, we talk about different ways to value companies because obviously just the tool is broken. And usually that's at the end of the move when people start having that kind of conversation. So I would say that this is probably a little too late. And I think it suggests, I think it plays into the narrative we've talked about before with, you know, when you have to rebalance the index because the biggest names have over dominated them, it tells you how extended they are. And I think a pullback would automatically reset that index probably in a pretty meaningful way. But yeah, that's happening pretty soon here.
You think 115 Apple would do that?
Well, right. I mean, so there's two ways that this fixes, right? Is that the market corrects itself and refixes it. 115 is quite a way below where we're at, though. I don't know if I would do that unless we're talking about a split of some sort. I doubt it.
Or a crash.
There's something, right?
I mean, no one thinks there could. Everyone's saying if there's going to be any kind of, you know, real dramatic market sell-off, that's going to happen in October, like it always does.
Well, so I mean, what's funny about 2023 is that it's playing out really in some classic ways. it's actually been stronger than you would expect, right? Months like
Right.
June are actually pretty weak, and we sort of went right through there. But with most years, and definitely in a pre-election year, that sort of rotation lower into the fall has played out so consistently, and we seem to be setting up perfectly for that same scenario that we always kind of, and I think that's a pretty decent way of playing it. But what I would say, Dale, is what I always talk to people about, doing a probabilistic analysis, which means as traders, we always think about a position, right? I'm short Apple, so here's what's going to happen. And then you sort of think through that. So you're sort of visualizing that scenario. What you have to remember is Apple could go down 5%. It could go down 15%. It could go up 5%. It could go up 15%. And thinking about each of those scenarios, what would that look like? What would that do to your portfolio? When would you take profits? When would you unwind something? When would you add to a position? Thinking of things in those terms, I think, is really helpful. So especially now where the market feels vulnerable, thinking of some different outcomes, what that might do to your current portfolio, when would you need to change positioning, how would you manage risk? That might just help you to anticipate and just deal with whatever unusual outcome sort of plays out here. Because I think there are a lot of paths we could take, and I think most of them, in my mind, most of them point to some weakness going into September, October. I think that's a pretty reasonable expectation given the run we've had so far.
Well, hopefully Tim Cook has moved enough of his manufacturing to India, in case China, which, you know, that relationship keeps getting more and more contentious. You know, Yellen visits, any visit from U.S. diplomat, we visit them as we're taking away, and now we're national security's higher than economics. So anyway, I think China, anyone who relies on China right now, I think they're vulnerable. So Apple does rely on China.
Yep, and a lot. I mean, with big tech, there are a lot of companies with vulnerability there for sure.
Yeah, I mean, you know, if we're adversaries, they have the potential to, you know, do some damage. Just something I'm thinking about instead of an invasion of Taiwan, because it's still a Cold War. So, David, what great looks again today, and the reasoning. You give the hows and the whys of what you're looking at, you know, when you're going through a market recap. And so people not only get your ideas of what can happen, but the why behind it, so that they're learning, and that they won't always have to, you know, see what David is saying to know what they learned from David. So you're a natural mentor, and it was great getting back together with you, Dave.
It's good to see you, Dale. Thanks for inviting me on today. Appreciate it.
Yeah. So, you know, everyone follow, at the minimum, follow Dave on Twitter at DKellerCMT, and go to his shows. He has great guests. He does a review that is as good as any of the guests that he does on stockchart.com. It's The Final Bar. And I don't know, the way things are, that's where I'd like to spend my last days, at the Final Bar.
Hopefully not anytime soon, Dale, but thanks again. I appreciate it.
All right, David, great talking with you. Dave Keller, everybody, follow him. He just showed you live what you can learn from him. Adios, David.
Take care, Dale. Thanks.
All right, and you could join the team in 16 minutes on the Morning Edge. Good luck today. Don't just count your pips, count your blessings. We'll see everyone tomorrow. Adios.